You are looking at a map of Europe. Your eyes naturally gravitate toward the economic titans. You see Germany with its massive auto industry. You see the United Kingdom with its financial empire in London. You see France with its luxury monopolies. And then there is Belgium, a country roughly the size of Maryland, famous mostly for waffles, chocolate, and having a government that once took 541 days to form because the politicians could not agree on anything. If you look at the surface, it makes no economic sense. They have some of the highest income taxes on earth, taking nearly half of a worker's paycheck. Their infrastructure is notoriously mediocre. By all conventional logic, this country should be a financial backwater. But here is the secret the flashy billionaires and tech bros do not want you to know. If you look at median wealth, the actual money in the pockets of everyday people, Belgians are quietly sitting on a mountain of cash and physical assets. They are consistently richer than the Germans, richer than the French, and richer than the British. How does a tiny, politically chaotic nation build such incredible, invisible wealth? Welcome to the Belgian Paradox. In this video, we're going to strip away the tourist stereotypes and look at the cold, hard mechanics of an invisible economic superpower. We're diving into the global choke point of Antwerp, the secretive diamond pipelines, and a unique cultural phenomenon known as having a brick in your stomach. Buckle up. We are about to redefine what it means to actually be rich. In 2010, Belgium broke a world record that no political scientist wanted to put on a trophy. For 541 consecutive days, the country had no functioning federal government, no prime minister, no cabinet. No one is sitting at the top of the machine pulling the levers. By every conventional theory of modern economics, this should have been catastrophic. Markets should have panicked. Businesses should have fled. The economy should have seized up like an engine with no oil. Instead, Belgium's GDP grew. Unemployment fell. The country, by almost every measurable metric, continued to function, and in certain sectors quietly accelerated. This is not a coincidence. It is a structural feature disguised as a political accident, and once you understand it, you will never look at the relationship between government and wealth the same way again. What the 541-day glitch revealed is something Belgium had been engineering into its economic architecture for decades. The country is built on radical decentralization. Power in Belgium is not held in one place. It is distributed across 3 regions, Flanders, Wallonia and Brussels, each with its own parliament, its own budget, and its own economic priorities. The federal government, the one that went missing for a year and a half, was never really the engine of Belgian prosperity. It was always closer to the exhaust pipe. When the politicians vanished, the regional governments kept running. The port kept moving cargo. The pharmaceutical plants kept shipping product. The diamond traders kept cutting stones. The bureaucratic superstructure of the EU, lodged permanently in Brussels, kept writing checks into the local economy regardless of who was or wasn't sitting in the federal cabinet. What Belgium accidentally demonstrated to the world is the central thesis that most high-income, low-wealth nations refuse to accept. The economy and the government are not the same thing. In the United States, in the United Kingdom, in France, the political narrative is built on the assumption that prosperity flows from Washington, from Westminster, from the Élysée Palace. Pull the federal plug, and the whole system collapses. Belgium proved that when your economic moats are deep enough, structural enough, and physical enough, they do not need a politician to defend them. This is the first lesson of the Belgian model, and arguably the most important one. Real wealth is not built on policy. It is not built on whoever wins the next election, or whatever the central bank decides to do with interest rates on a Tuesday afternoon. Real wealth is built on infrastructure, on geography, on physical assets, and on systems so deeply embedded in the global supply chain that the world has no practical choice but to keep paying you whether you have a government or not. Belgium didn't survive 541 days without a government because it got lucky. It survived because it had spent a century building an economy that doesn't need one. Pull up a map of Europe and trace the Rhine River as it flows north out of Germany, cuts through the industrial heartland of the continent, and empties toward the North Sea. Now look at where the cargo has to go before it reaches open water. It goes through Belgium. Specifically, it goes through Antwerp, and that single geographical fact is worth more to the Belgian economy than any tax policy, any trade agreement, or any government initiative ever conceived. The Port of Antwerp is not just a port. It is the circulatory system of European commerce. It is the second largest port in Europe by cargo volume, but raw tonnage figures dramatically understate its actual economic gravity. What Antwerp handles is not bulk commodity shipping in the way Rotterdam does. Antwerp specialises in high-value, high-complexity cargo: automobiles, chemicals, pharmaceuticals, electronics and perishables. The categories of goods where logistics precision creates enormous economic leverage. If something is expensive, time-sensitive, and needs to move flawlessly from a factory floor in Germany to a retail shelf in North America, there is a very high probability that it passed through a Belgian terminal. Roughly 15% of all European GDP flows through Antwerp's infrastructure every single year. The port directly and indirectly employs over 150,000 people in the region. It generates roughly 9% of Belgium's total GDP from a physical footprint that occupies less than 20,000 acres of Flemish soil. On a pure output per acre calculation, it is one of the most economically productive pieces of land on the surface of the earth. Here is what this means in practice for understanding the Belgian wealth model. The port is a toll road that never closes. Every container that passes through generates warehousing fees, customs processing revenue, forwarding commissions, insurance premiums, and chemical storage contracts. The port is home to the largest integrated chemical cluster in the world outside of Houston, Texas. Companies like BASF, Baker, Air Liquide, and ExxonMobil have made permanent, multi-billion-dollar capital investments inside the port perimeter, specifically because once you are embedded in Antwerp's logistics network, the switching cost of leaving is functionally prohibitive. This is the concept of a physical economic moat, and it is the most durable form of competitive advantage that exists. A software platform can be disrupted overnight. A tax incentive can be legislated away in a budget cycle. A cultural trend can reverse in a single quarter. But a port that sits at the mouth of the Rhine, connected to 500 million consumers by road, rail, and river, and surrounded by 50 years of sunk-cost chemical infrastructure, that moat does not erode. It deepens every year that another company bolts another pipeline to the ground. Belgium did not choose its geography, but it had the structural wisdom to build an economy around it, and that distinction between countries that exploit their permanent advantages and countries that chase temporary ones is exactly what separates deep generational wealth from the illusion of it. Walk down Hoveniusstraat in Antwerp on any given weekday morning, and you will pass men in black coats carrying briefcases that contain more value per square inch than almost anything else moving through a European city. No armoured vehicles, no obvious security theatre. Just a street, a briefcase, and a handshake culture so deeply embedded in trust and reputation that it has functioned as the global standard for rough diamond trading for over 5 centuries. The Antwerp Diamond District occupies roughly 1 square mile of real estate. Within that square mile, approximately 84% of the world's rough diamonds pass through at some point in their journey from mine to market. That number deserves a second reading. Not 84% of Belgian diamonds, not 84% of European diamonds, 84% of all rough diamonds on Earth, regardless of where they were pulled from the ground, are valued, traded, cut, or certified in a single square mile of a small northern European city. This is not a historical accident that has been slow to correct itself. It is a deliberately maintained monopoly built on 3 interlocking pillars that are almost impossible to replicate from the outside. The first pillar is concentrated expertise. The craft of diamond cutting and valuation has been passed down through tightly knit communities in Antwerp for generations, creating a density of specialised human capital that no competitor has successfully displaced. Cities in India, Israel and Dubai have grown their own diamond industries, but they all still reference Antwerp pricing as the global benchmark which means the city functions as both the market and the arbiter of value simultaneously. The second pillar is institutional infrastructure. The Antwerp World Diamond Centre acts as a regulatory and certification body whose credibility is backed by centuries of transactional history. In a market where a single stone can be worth millions of dollars and authenticity is everything, the institution that controls the paper trail controls the market. The third pillar is the legal and banking framework that has evolved specifically around the diamond trade. Belgian banks, Belgian insurance companies, and Belgian legal structures have developed bespoke products that serve the unique risk profile of trading rough stones. Moving that infrastructure to another jurisdiction would not just require physical relocation, it would require rebuilding an entire ecosystem of financial services that took generations to construct. The economic lesson here is not about diamonds. It is about what happens when a nation captures the valuation layer of a global luxury market, rather than simply the production layer. Belgium does not own the mines. It owns the definition of what the mines produce. In a world where perception of value is everything, controlling the moment when raw material becomes a recognised asset is worth more than controlling the raw material itself. Belgium figured this out before most countries had modern financial systems, and it has been collecting that premium ever since. When the world needed vaccines at industrial scale, the supply chain ran through Belgium. This was not improvised emergency logistics. It was the natural output of a pharmaceutical and biotech manufacturing base that Belgium had been quietly constructing for decades, largely invisible to anyone who wasn't already operating inside the industry. UCB, one of the world's leading biopharmaceutical companies, is Belgian. Galapagos, a clinical stage biotech that drew a landmark partnership with Gilead worth nearly $5 billion, is Belgian. Janssen Pharmaceutica, the division of Johnson & Johnson responsible for some of the most significant drug developments of the past 30 years, was founded in Belgium and still maintains major manufacturing operations there. The country produces a disproportionate share of the world's active pharmaceutical ingredients relative to its size, and during acute global health crises, that production capacity moves from an economic asset to a strategic one. The reason Belgium became a pharmaceutical powerhouse is not accidental, and it follows the same structural logic that explains the port and the diamonds. Belgium made early, deliberate investments in the institutional infrastructure that pharmaceutical development requires. The Catholic University of Leuven, KU Leuven, has been one of Europe's leading research institutions for over 5 centuries, and is currently ranked among the most innovative universities on the continent by patent output. The proximity of world-class academic research to a skilled, multilingual, technically educated workforce created the conditions for pharmaceutical clusters to form and compound over generations. Add to that the Belgian government's historically stable regulatory environment, its central location for European clinical trial coordination, and its sophisticated chemical manufacturing base already anchored in the port of Antwerp, and the picture becomes clear. Pharmaceutical companies didn't locate in Belgium because of a particularly generous tax incentive in a particular year. They located there because the entire surrounding ecosystem, the talent, the infrastructure, the logistics, the legal framework, made Belgium the highest probability location on the continent for complex precision manufacturing. This is the pattern that runs like a thread through every chapter of Belgium's economic story, and it is the pattern that separates structural wealth from cyclical income. Belgium is not rich because it caught a trend at the right moment. It is rich because it kept making investments in the physical and institutional foundations of industries that the world would permanently need: logistics, materials science, and medicine, long before those industries became glamorous or widely understood. The wealth that pharmaceutical manufacturing generates in Belgium does not show up in ways that make headlines. It shows up in employment density, in export value, in the quiet accumulation of technical IP inside companies that most people outside the industry have never heard of. It is exactly the kind of wealth that is invisible to the casual observer, which is precisely why it has been allowed to compound undisturbed for so long. Here is the number that stops every conversation cold. Belgium has a marginal income tax rate of approximately 50%, not for the ultra-wealthy, for a reasonably well-paid professional. If you are earning a solid middle-class salary in Brussels, half of every additional euro you earn above a relatively modest threshold goes directly to the state. By the standard metrics of personal financial advice, minimise your tax burden, maximise your take-home pay, optimise your cash flow, Belgium looks like a fiscal nightmare. It looks like the last place on earth a rational wealth builder would choose to operate. This is the trap. This is the illusion that the entire Belgian model is designed, intentionally or not, to exploit. Because while Belgium extracts aggressively from your labour income, it does something almost no other developed economy does with the same commitment. It leaves your investment returns almost entirely alone. Belgium has no capital gains tax on the sale of standard stock market investments for private retail investors, not a reduced rate, not a simplified flat tax. Zero. If you buy shares in a diversified equity portfolio and hold them for years while they compound in value, the profit you realise when you eventually sell is, under Belgian tax law, not considered a professional income, and is therefore not taxed as ordinary income. The state takes half of what you earn at your desk and nothing of what you earn from your portfolio. Sit with the full architecture of that incentive structure for a moment. A system that taxes labour heavily and capital gains lightly is not, at its core, a system designed to redistribute wealth. It is a system designed to teach its citizens the difference between earning money and building wealth, and to reward the latter with extreme prejudice. The predictable behavioural result is a population that has learned, across generations, to minimise reliance on labour income as a wealth-building mechanism and to maximise the velocity of capital deployment into appreciating assets. You pay your taxes on what you earn. You protect everything else by putting it to work. The Belgian middle class did not develop its high net worth profile by accident. It developed it because the tax code spent decades making the lesson unavoidable. Most high-income, low-wealth individuals in the United States or the United Kingdom are operating under a mental model in which earning more is the solution. Get the raise, chase the promotion, land the better contract. The Belgian system makes that framing structurally untenable. You can earn more, but the state is waiting at the door to collect its share. The only durable path is to stop optimising for income and start optimising for assets, because assets are where the system stops penalising you and starts leaving you alone. This is not a loophole, it is the entire blueprint. There is a phrase that Belgians use that does not translate cleanly into English, but communicates something essential about how the country thinks about money. They say a Belgian is born with a brick in their stomach. It is not a medical condition. It is a cultural orientation, a deep, almost irrational compulsion toward owning physical property that is woven into the national identity as thoroughly as language or cuisine. Belgium has one of the highest home ownership rates in Western Europe, consistently above 70%. This is not explained by generous government housing subsidies or unusually accessible mortgage markets alone. It is explained by a multi-generational cultural consensus that renting is, in the most fundamental sense, a wealth-destroying activity, a permanent exchange of money for nothing that accumulates. Ownership is not aspirational in Belgium, it is the baseline. The question is not whether you will own property. The question is when and how aggressively you will continue to acquire it. What makes the Belgian approach to real estate structurally interesting rather than simply culturally quaint is how it interacts with the capital gains tax architecture described in the previous chapter. Real estate in Belgium is subject to its own specific tax treatment, and while there are nuances around registration fees and inheritance structures, the central principle holds: the appreciation of physical assets over long holding periods is taxed far more leniently than the income generated by showing up to work. The system, once again, rewards the patient accumulation of hard assets over the consumption of labour income. The behavioural pattern this creates at the household level is strikingly different from what you see in high-income Anglo-American economies. The Belgian wealth builder is not trying to maximise their lifestyle against their income. They are trying to minimise their lifestyle against their income in order to redirect as much capital as possible into property that will appreciate, carry rental income, and eventually be transferred to the next generation with minimal tax friction. The house is not a home in the purely emotional sense. It is the first unit in a portfolio. This is the brick in the stomach made operational. It is the physical manifestation of the same logic that runs through the port, the diamond trade, and the pharmaceutical sector. In each case, Belgium identified the category of asset that produces durable, compounding value over long time horizons and organised its institutions, its culture, and its incentive structures to accumulate it relentlessly. At the national level, that asset is logistics infrastructure and intellectual property. At the household level, it is the land and the buildings on it. The scale changes, the principle does not. The modern consumer economy in the United States and the United Kingdom has spent decades convincing its participants that experiences, status symbols, and consumption are the legitimate rewards of high income. Belgium quietly and without much fanfare never bought that argument. It kept stacking bricks. There is a category of economic advantage that almost never appears in the standard analysis of national wealth, and Belgium has been quietly collecting it for 7 decades. It is the advantage of being the address, not the manufacturer of a product, not the exporter of a commodity, the physical location where power chooses to live, and everything that flows from being that location permanently. Brussels is the de facto capital of the European Union. It hosts the European Commission, the European Council, the European Parliament's primary administrative offices, and the headquarters of NATO. This is not an arrangement that changes with election cycles or renegotiates itself every decade. These institutions have built permanent infrastructure in Brussels, office complexes, residential neighbourhoods, school systems, transportation networks, and the structural cost of relocating them is so prohibitive that the question is essentially theoretical. Brussels is the capital of European institutional power, and it will remain so for the foreseeable future. The direct economic injection is substantial and largely recession-proof. The EU institutions alone employ tens of thousands of high-salary civil servants in Brussels, almost all of whom pay local income taxes, spend locally, and drive demand for housing, services, and commercial real estate in a concentrated urban geography. Add the estimated 25,000 lobbyists, consultants, lawyers, and NGO representatives who have permanently based themselves in Brussels specifically to be near the institutions, and you have an entire professional ecosystem whose economic existence is entirely dependent on Belgium's role as institutional host. This is what economists call the Brussels effect when they are discussing regulatory influence, but its economic cousin is equally powerful. When you are the city where the rules are written, you attract everyone who needs to be in the room when the rules are written, and you collect rent from all of them. Office space in the European quarter commands premium prices. The international school sector in Brussels is one of the most developed in the world, servicing the children of the permanent diplomatic and institutional class. The hospitality and events industry runs at above-average utilisation because the EU calendar generates a constant drumbeat of summits, sessions, and ministerial meetings that fill hotels regardless of broader economic conditions. The deeper principle here is one of platform economics applied to physical geography. Belgium does not need the EU to be economically successful. The port would still run, the diamonds would still be cut, and the pharmaceutical plants would still ship product if the EU institutions relocated tomorrow. But the EU institutions sitting permanently in Brussels function as a baseload economic generator, a guaranteed, inelastic source of demand that insulates the local economy from the cyclical volatility that afflicts cities entirely dependent on a single industry or a single employer. Belgium is the EU's landlord, and like all good landlords, it collects its rent regardless of who is winning or losing the political argument upstairs. When most people think about Belgian exports, they think about chocolate, artisan pralines in a gold-embossed box, small batch truffles in a boutique shop window in Bruges. It is a pleasant image, and it is almost entirely irrelevant to understanding how Belgium actually projects economic power across the global consumer landscape. Forget the chocolate shop, look at the brewery. In 2016, Anheuser-Busch InBev, a company headquartered in Leuven, Belgium, completed its acquisition of SAB Miller for $107 billion, the largest consumer goods transaction in corporate history at that point. The resulting entity controls approximately 30% of the global beer market by volume. Budweiser, Stella Artois, Corona, Leffe, Hoegaarden, Beck's, Modelo, and roughly 500 other beer brands are owned by a single Belgian holding company. When a construction worker in Sao Paulo cracks a Brahma at the end of a shift, he is generating revenue for a Belgian conglomerate. When a college student in Shanghai orders a Harbin, the margin flows back to Leuven. This is the Belgian soft power model at its most extreme expression, but it is not an isolated example. It is the output of a business culture that has historically preferred building durable, cash-generating holding structures over building flashy, high-growth consumer narratives. Belgian corporate culture, shaped by the same institutional DNA as Belgian household culture, gravitates toward assets that produce reliable cash flows across long-time horizons rather than toward maximum short-term valuation. It is the brick-in-the-stomach philosophy applied at the corporate level. Buy the thing that the world will always consume, structure it efficiently, and let the compounding do the work across decades. The AB InBev story also illustrates something important about how small nations punch above their weight economically. Belgium did not build a globally dominant company by competing on market size, population density, or domestic consumption. It built one by leveraging capital discipline, a sophisticated financial infrastructure, and a willingness to make patient, long-duration bets on industries with structural demand. Beer is not a trend. People will be drinking it in 2075 with roughly the same consistency they are drinking it today. A B InBev is not a growth, stock in the conventional sense. It is a generational cash flow machine wearing a consumer brand costume. This is the final piece of the Belgian economic portrait before we synthesize the full picture. Belgium's economic dominance is not built on innovation in the Silicon Valley sense, on disruption, on network effects, or on any of the fashionable frameworks of modern wealth creation. It is built on identifying the categories of human need and global commerce that are structurally permanent. Movement of goods, hard assets, essential medicines, institutional power, universal consumption, and then quietly, systematically, without much noise or fanfare, positioning itself at the centre of each one. By now, the pattern should be impossible to unsee. Belgium did not become one of the wealthiest nations per capita on Earth by chasing the next wave, optimising for visible success, or building an economy designed to look impressive from the outside. It became wealthy by doing something that most individuals, most households, and most nations find psychologically difficult to sustain over long-time horizons. It identified the structural foundations of permanent value, physical infrastructure, essential goods, institutional proximity, hard assets, and patient capital, and it compounded its position in each of those categories, quietly and without distraction, across generations. The port did not get built in a year. The diamond district did not achieve its global monopoly in a decade. The pharmaceutical clusters did not emerge because of a single government incentive. The household wealth embedded in Belgium's home ownership culture did not accumulate in a single property cycle. Every piece of this economy was built slowly, deliberately, and with a clarity of purpose that the modern financial media landscape, obsessed with quarterly earnings, viral narratives, and overnight millionaires, is structurally incapable of covering. This is the blueprint, not a complicated one, not a secret that requires special access or insider knowledge. Buy the hard asset when everyone else is renting. Hold the equity position when everyone else is trading. Build the business model around the things people will permanently need rather than the things they currently want. Structure your tax exposure around capital rather than labour income. Ignore the political noise, because the political noise, as 541 days of Belgian non-governance demonstrated, has almost nothing to do with the actual mechanisms of wealth creation. The modern financial trap, the one that leaves high-income Americans and Britons with high debt and low net worth at the end of a 40-year career, is not a trap built from laziness or bad luck. It is a trap built from a fundamental confusion between earning and owning, between income and wealth, between the appearance of financial success and its substance. Belgium, as a country and as a culture, resolved that confusion a long time ago. The brick in the stomach is not a charming folk metaphor. It is a precise description of what a correctly calibrated financial instinct actually feels like. The constant low-level pull toward acquiring physical, durable, appreciating assets rather than optimizing the consumption of cash flow. You're not Belgian. You were probably not raised with that instinct, but the instinct is learnable. The framework is transferable. Stop looking at what the flashiest economies are doing and start studying what the quietest ones own. Stop measuring your financial progress by your income. Bracket and start measuring it by your asset base. Stop acting like a consumer who earns well and start acting like a holding company that deploys capital deliberately. The Belgians have been running this play for 5 centuries. You can start today. And if this video gave you one idea that shifts how you think about building wealth, do one thing before you leave. Subscribe. Not because it helps the algorithm, although it does, but because every video on this channel is built on the same principle. This one ended on finding the structural truth underneath the noise and following it wherever it leads. That is the only financial advice worth giving. Everything else is just marketing.